China is not Russia. China is 20% of the world GDP. Russia was like Mickey Mouse. You can get away with sanctioning Russia. You're not going to get away with sanctioning.
China was dead. China's going to die. China's going to die. China's going to die. I think it was like over a 10 to 15 year time frame.
Don't buy GDRs or ADRs. Going to buy Hong Kong stocks.
History would indicate that owning hard assets is an extraordinarily good idea in that environment.
Bloomberg had a story recently about China in a deflationary cycle, possibly requiring some financial move from Chinese authorities. True, or is this just noise from the West? Chinese equities are already pretty cheap. Opportunities getting even better going forward. Thanks for all you guys do. Let's take that one first.
On the Chinese one, I saw, oh gosh, it was probably about a year ago now, a collection some guy had put, and I can't find it. It was on, I think, on a Substack. A guy had taken the collection of articles out of Western media, Reuters, Bloomberg, CNBC, over the course of like 10 years. And it was just this voluminous narrative that China was dead, China's going to die, China's going to die, China's going to die. I think it was like over a 10 to 15 year time frame. And you look at it like every single time these people are wrong, but then you also understand who owns this media. So I would caution one to consider the media. Look, this is the same media that told you to take a safe and effective, okay?
Yes, that's true.
So, after having my Russian ETF and Gazprom traded on the US exchanges rendered worthless in 2022 by Biden government decree, with Chinese equities, one may want/need to factor in the same serious risks if US government decision is to hurt its own citizens as it did with Russian equities and no official war has been declared. Joel, the question I have for Chris, Brad, and the team is whether they think that this risk is already baked into Chinese equity prices, or are Chinese equities mostly determined by the local investing market? Thanks. That's from John V.
All right. So first of all, yes, we think that definitely the risk of Chinese equities getting pinched from you or whatever is priced in. These things, or look, whatever's priced in, I don't know what the hell. These things are cheap. It's really, really easy
to find. Never really know what all of the pieces of that puzzle as to why it's priced accordingly.
Yeah.
We know that it's very cheap.
In fact, we've got to sort of hold off on getting too exposed to China. I mean, take us up to 10%, or dividend portfolio might be a little bit higher, maybe 12, 15%. But first of all, okay, so lessons from Russia. Right. So, well, if there's any lessons, it would be don't buy GDRs or ADRs. If you're going to buy Hong Kong stocks or Chinese stocks, buy it in a home exchange. In Russia, in our portfolios, my own portfolio, we bought stock on the Russian exchange. Still got them. Can't trade them. And some of these things have gone exceptionally well. So the lesson would be just don't buy the GDRs and just buy on the home exchange, the original, the home listing. Don't buy ETFs, buy stocks on the exchange. So if we hadn't bought GDRs, we did buy a few, and we didn't buy any Russian ETFs. But if you avoid buying Russian ETFs and avoid buying GDRs in London and just bought the home listings in Russia, you would still have those, and you'd be looking at going, well, gee, that's not so bad. I can't trade it, but hey, whatever. Just on that, eventually things change. Maybe next year, Trump gets in and he sort of normalizes relations with Russia, and hello, we're trading again, away we go. Maybe it's 4 years' time. Who knows? But eventually, it'll come back. And I guess the other thing is limit your exposure. So, shit happens. Gosh, I know one guy, Chris and I both know him. He's a fund manager, actually. And he was a significant proportion of his funds invested in Russian equities. And poor bugger, his fund is actually, to his credit, he did invest on the Moscow exchange, and he's still got them all. But he, can't take fees, can't get performance fees, etc., etc. I guess
Basically
people
businesses.
Yeah, his business is buggered. But by the same token, Chris, people can't take the money out either.
Yeah. No redemptions. That's good.
Redemptions.
Yeah.
There we
It
go.
just look, we're in a part of the cycle where you have what Lennon said. There are decades where nothing happens, and then there are days where decades happen, and that's really where we're at. So, but broad diversification is important. So, and the lesson that we had as well, which you alluded to there, was while we had sort of that exposure to those Russian equities, and you took away what was a significant portion of the oil industry, global oil industry, all the other equities that we had, which were in that same industry that weren't Russian equities, all soared. They all flew. And so when I think about something like China, because people are now concerned about China, should they sanction Chinese equities? That's an act that's going to be treated as an act of war. And then you say, well, what happens in an environment like that? Well, history would indicate that owning hard assets is an extraordinarily good idea in that environment. So we could argue that the rest of our portfolio, which is by and large pretty heavily weighted towards hard assets, would outperform accordingly. So it becomes then a question of what is the weighting that one would have within your portfolio to that. You can't eliminate risk, you can only manage it.
Yeah, it's an important point. China is not Russia. China is 20% of the world GDP. Russia was like Mickey Mouse. You can get away with sanctioning Russia. You're not going to get away with sanctioning all the shit on your table. You know, the clothes on your back, so on and so forth, the computers, everything. It ain't going to work. So, you know, sanctioning China is but like it's almost like a joke, like, you know, net zero 2050. Like, no, ain't going to happen.